Welcome back to the Deep Dive. We're here to cut through the noise and give you the essential insights. Today, we are really digging into PayPal, our source material. It's gold. Excerpts directly from the CEO's opening remarks during their recent Q3 earnings call.
Exactly. And our goal here is to get past the surface level. We want to understand the actual strategy driving PayPal right now. They're making some pretty big claims about acceleration, about profitability, moving beyond just processing payments to being a full commerce company. We're looking for the concrete proof, the aha moments that show this turnaround is real.
And the CEO really set the stage immediately, didn't he? He made that core claim right up front. The company is fundamentally stronger now than 2 years ago. That's quite a statement for a giant like PayPal. So, okay, let's unpack that. Where's the evidence? What proves they're stronger?
Well, it starts with this turnaround story they're telling. The CEO pins it on basically focus and execution. Simple terms, but apparently effective. They claim this led to a positive inflection across the whole business. And when you look at the financials they shared, that inflection, it's pretty clear.
Yeah, let's anchor this in the numbers, because the shift is, frankly, pretty stunning. Just 2 years back, their transaction margin dollar growth, that's, the profit per transaction, it was actually negative. And that's excluding the interest they earn on customer balances.
Right. And excluding that interest is key. It forces you to look at the core health of the payments business itself without interest rates confusing things. So negative growth back then, that signals a real problem. But now the target for 2025 is 6% to 7% growth. That kind of reversal in a system as big and established as PayPal, it's tough. It suggests a real structural fix.
And they're framing this not just as a quick patch-up job. They're setting long-term goals now that assume this new, more profitable structure holds. They're projecting non-GAAP EPS growth hitting at least 15% this year. And the long-term aim, high single-digit growth for that transaction margin dollar figure and EPS growth in the teens or even better.
And what's really interesting is how they're using this new profitability. It's not just about reinvesting. They announced a pretty significant capital return plan for shareholders. They're starting a dividend. That's alongside ongoing share buybacks. The message seems to be, look, our free cash flow is strong enough now to invest heavily in transformation and give cash back to shareholders.
Okay, hold on a second. This is where I get a bit skeptical. Isn't starting a dividend sometimes seen as, a sign that a company's out of high-growth ideas? How does that square with claiming radical acceleration and pouring money into next-gen growth? Seems a bit contradictory.
That's the million-dollar question, right? And the CEO's narrative is that the dividend is possible because the business is now fundamentally more efficient and profitable. They're basically saying, we fix the engine while speeding up. The claim they can do both simultaneously. This whole thing is branded as the new PayPal, built for faster, more profitable growth. The capital plan is meant to signal confidence that they've cracked the code on efficiency and growth.
All right, so if that's the financial bedrock, how are they actually building on top of it?
Yeah.
The CEO laid out 4 specific strategic pillars for the future. Let's list them out. 1, winning checkout. 2, scaling Omni and growing Venmo. 3, driving PSP profitability. And 4, scaling next-gen growth vectors.
And looking at Q3, the results seem to back this up. They hit or beat their guidance pretty much everywhere. But the key thing, I think, is where that transaction margin dollar growth is coming from now. It's diversified. It's spread across their branded experiences, the PSP business, and Venmo. That shows they aren't just relying on one thing anymore, which adds stability.
But the CEO said the real story wasn't just revenue. It's engagement. Monthly active accounts, MAAs, they grew. Okay, 2% year over year. Steady, fine. But here's the kicker, the really interesting bit. Transactions per active account, if you exclude PSP, that grew 5%.
And that is the signal. That's the proof they're deepening the relationship with existing users. It means people are using PayPal and Venmo more often, weaving it into their daily lives, as the CEO put it. Increasing frequency like that, that's often much more valuable long-term than just adding lots of new occasional users.
And that deeper engagement, that's the fuel for their whole omni-channel ambition, right? The strategy seems laser-focused on shifting PayPal from just being an online payment button to being a commerce company that's there everywhere they shop. Online, in-store, maybe even through AI agents eventually.
Exactly. They're deliberately pushing beyond just online retail, which is getting crowded. They're moving into services, subscriptions, everyday spending, areas with more growth potential. And this broadens their total addressable market significantly. We're already seeing results, too. Branded experiences TPV growth, that accelerated to 8% currency neutral over the last 4 quarters. That proves the strategy's grabbing new kinds of transactions.
Okay, let's get more granular. Let's dive into the specific growth levers they're pulling. We need to really understand this flywheel effect they keep mentioning, especially the U.S. proof points.
Right. The U.S. data is basically their internal case study. Their branded experiences volume growth there hit 10% in Q3. That's
Yeah.
more than double the growth rate from the same time last year. That's not just growth, it's accelerating growth.
And the key to unlocking this seems to be getting users to use more than one product. Look at the PayPal debit card data. This number blew me away. A user who actively uses the debit card, they transact almost 6 times more often, and they generate nearly 3 times the ARPA that's average revenue per active account compared to someone who just uses PayPal at checkout.
So why is that jump, that 3x ARPA, so dramatic? What's the mechanism? Well, the moment someone adopts that debit card, PayPal stops being just a checkout option and becomes more like, well, part of their daily financial plumbing. They're more likely to keep a balance, which cuts down friction for payments, boosts authorization rates, and lowers transaction costs for PayPal. Just getting that second product adopted unlocks huge value.
And they're seeing a similar pattern with Buy Now, Pay Later, or BNPL. The CEO actually called BNPL a fundamental change in how people pay. BNPL volume is consistently growing around 20% quarter after quarter. They expect to process almost $40 billion in BNPL volume in 2025.
And customers seem to genuinely like it. The Global Net Promoter Score, or NPS, is 80. That's incredibly high for any financial product. But the strategic shift here is really important. They're trying to move BNPL from being just another payment option you find hidden after you decide to buy to making it a front and center customer acquisition tool.
Right, through that upstream presentment idea. Can you translate that jargon for us? What does that mean practically for someone shopping online?
Yeah, sure. Think of it like this. Instead of clicking checkout and then maybe seeing pay in 4 inside the PayPal options, upstream presentment means you see pay in 4 with PayPal right there on the product page itself or in your shopping cart before you even hit checkout. It makes BNPL part of the decision to buy, not just how you pay. That pulls in new users and boosts engagement.
Okay, let's shift to Venmo. They're positioning it as the money platform for the next generation young, often more affluent, digitally savvy. And Venmo definitely seems to be hitting its stride. TPV grew 14% in Q3, which is actually faster than the 12% in Q2, so acceleration there too.
And the money-making side is finally starting to catch up to the huge user base. Venmo's on track for $1.7 billion in revenue this year, if you exclude interest income. That revenue growth rate is like 10 points faster than 2 years ago. So whatever they're doing to monetize peer-to-peer payments, it seems to be working.
And here's where that ARPA multiplier story gets even crazier than the debit card. Today, the average Venmo user generates just over $25 in revenue per year. Kind of low, right? But look at the small group of users who are engaged across PDP, the debit card, and Pay with Venmo. Their ARPA, it's about 4 times higher.
But wait, there's more. The real prize, the 6 times multiplier, that comes from users who also bring funds into Venmo. So things like direct deposit or instantly adding cash. If a user does that, the ARPA jumps to 6 times higher. The business logic is clear, isn't it? Once Venmo becomes someone's primary money hub where their paycheck lands, funds are always available. That cuts down on costly bank transfers or card fees for PayPal, and it embeds Venmo deeply into their financial routine. That 6x user, that's the target.
And the encouraging sign for them is that adoption of these extra features is speeding up. New Venmo users are grabbing that debit card almost 4 times faster than they were just 2 years ago. The potential, just by nudging their massive existing user base towards that 6x engagement level, it's enormous.
Okay, let's pivot to the merchant side of things. The PSP business, payment service provider. This is where they offer payment solutions directly to businesses. The CEO said this area has turned a corner. Volume growth accelerated to 6%, up from just 2% last quarter. So positive momentum there.
And this growth is profitable, they claim, because the focus isn't just processing payments anymore. It's about building holistic relationships with merchants. What does holistic actually mean here? Are they just handling the transaction, or is it more involved?
Oh, it's definitely more involved. Holistic means going beyond basic processing to offer value-added services VAS. Think things like handling payouts for merchants, managing currency exchange risk with FX as a service, helping them improve payment authorization rates. These are services merchants actually want and need because they directly impact their bottom line: better sales, lower costs, smoother international business. PayPal aims to be their financial OS, not just the checkout button.
All right, and the last pillar, Scaling next-gen growth vectors.
Yeah.
This is the future-looking stuff. Innovation speed, especially around agentic commerce.
Yeah, this is their bet on how shopping might evolve with AI. Think about consumers using AI assistants powered by LLMs like Google's, OpenAI's, Perplexity's to find and buy things. The CEO specifically mentioned the OpenAI partnership, enabling payments within ChatGPT. The strategy is basically position PayPal as the default payment plumbing for this whole new AI-driven commerce world.
And the value prop for merchants is potentially huge, right? Instead of building separate integrations for every new AI shopping agent that pops up, they integrate with PayPal once and potentially reach consumers across all these different platforms seamlessly. It's about future-proofing.
Exactly. And they're making other future-proofing moves too. That PayPal World initiative, focused on making different digital wallets work together smoothly, that's now officially in pilot testing. They had their first test transactions happening right around the earnings. They did admit that sorting out all the old legacy tech integrations is complicated and takes time. It's a slow process. But the early results seem to justify the effort. In the optimized U.S. groups, they're seeing about a 1 percentage point lift in conversion. And when you combine that new checkout design with biometric login, like fingerprint or Face ID, the conversion improvement jumps to between 2 and 5 percentage points. For a business processing billions, even small percentage point gains are massive. It backs up the CEO's line. It's a when, not if, they get the full benefit globally.
So wrapping up the CEO's perspective here, the message is clear. They believe they shifted the company from playing defense to playing offense, from just stabilizing to truly accelerating. And the data, at least directionally, seems to suggest the growth engine is becoming more balanced, more frequent, and crucially, more profitable than it was.
Yeah, I think the final takeaway for you, listeners, is to be this clear strategic shift. They are moving decisively from being just an online payments button to by becoming a multi-channel commerce platform. And the success of this whole huge expansion really rides on that flywheel effect. It's not just about getting new users anymore. It's about converting their enormous existing base into these multi-product, high-value users, the ones using debit, BNPL, maybe direct deposit, unlocking that 3x to 6x revenue potential per customer. That's the game changer for them.
Which brings us to the final thought for you to chew on. Given that incredible 6x ARPA multiplier for a fully engaged user, someone using P2P, debit, pay with Venmo, and bringing funds in, the defining question for PayPal's future isn't really about adding more accounts, it's about execution. How quickly, how effectively can they actually migrate that colossal existing user base from just using one product occasionally to becoming those deeply engaged, multi-product, high-value customers? That migration, that's where the billions in future revenue really lie.